This story begins with a man named Colin Catel. He is the founder and CEO of Palisades Gold, a company that has become one of the most active financiers in the junior mining sector today. His journey did not start in a boardroom. It started at home watching his father. Colin's father worked in the mining industry from around 2002 to 2012. During that time, he did very well. He made a lot of money, but later, during a difficult bear market, he lost much of it. For most people, that kind of loss would feel like a failure. For Colin, it became a lesson. He watched his father win big, then watched him struggle. That experience shaped the way Colin would later build his own company. Palisades Gold did not begin as a mining investment firm. It started small, as a private company offering consulting and investor relations services. Colin worked hard, but he later said this kind of work never fully satisfied him. He was telling other people's stories, not building his own. Still, this early work gave the company something valuable: capital. The capital became the foundation for what came next. Around 2015 and 2016, Palisades began actively picking up mining ground. This led to the creation of several companies, including Newfound Gold and Nevada King Gold. From that same effort, Earth Labs was formed, which later became known as Gold Spot. Made in America, gold also grew out of this period. Slowly, an entire group of companies took shape under the Palisades name. The real turning point came in 2019. Newfound Gold hit what is known in the mining world as a discovery hole, a moment when drilling reveals a mineral find significant enough to change everything. This discovery changed the direction of Colin's career. For 4 years, he managed Newfound Gold while it was a public company. He learned a great deal during that time, but eventually he decided it was time to step back and let experienced mine builders take over the next stage of development. This decision allowed him to return his full attention to Palisades Gold, the company he considered his true passion. Early in 2024, Colin and his team believed something important was happening. They sensed that a new bull market in gold was beginning. At the time, gold prices were already rising by 50 to 60%. Yet very little money was flowing into junior mining companies. Most investors were not paying attention to this smaller, riskier corner of the market. Palisades saw this as an opportunity, not a warning sign. So they made a decision. Instead of simply buying shares like a typical investor, they began writing checks directly to mining companies during financing rounds. In return, they often received something called a warrant, along with shares. Over time, this strategy led Palisades to build stakes in 330 different companies. Among these investments were well-known names. Palisades holds 6.6% ownership in Frank Jostra's Copper Giant, a company that has previously been featured on this very channel. They also hold ownership in Eric Sprott and First Majestic Silver's joint venture, Silver Storm. Other names in their portfolio include Surge Battery Metals, Talisker, and Southern Silver, companies covering not just gold and silver, but also copper, lithium, and other critical minerals. By focusing heavily on long-dated warrants, Palisades built exposure to strong teams and promising projects at a lower upfront cost. This approach is not something new investors could easily copy today. As the market has changed, financing terms have shifted, competition has increased, and fewer companies now offer warrants as generously as they once did. To understand this story, viewers first need to understand what a warrant actually is. A warrant is not a share. It is an option, but not an obligation, to buy a share at a fixed price for a set period of time. Rick Rule, a well-known figure in the mining world, has described it exactly this way. There are two common paths for someone who wants to invest in a mining company. The first is simple. A person can buy shares directly on the open market, the same way most people invest in any public stock. The second path is different. An investor can write a check directly to the company when it raises money through what is called a financing round. In exchange, the investor receives something called a unit. That unit usually includes one share and one warrant attached to it. The share can be kept or sold depending on the investor's choice. The warrant works differently. It stays active for however long its terms allow, sometimes for several years. During that time, the holder has the right to buy an additional share at a price that was fixed when the warrant was issued, no matter how high the stock later climbs. Colin Catel explained this using Copper Giant as a real example. Palisades participated in a financing round at around 20 cents per share. As part of that deal, they received a 3-year warrant with a strike price of 28 cents. At the time, that price seemed reasonable. Palisades chose to sell the original shares around the 20-cent mark, but they kept the warrants. Since then, Copper Giant's stock has climbed to around 70 cents. That means the warrants are now worth about 50 cents each above their fixed price and growing. With 2.5 years still remaining before expiration, Palisades has time to decide whether to exercise those warrants and hold the position, or eventually sell if they believe the stock has become overvalued. This example shows why warrants can offer significant upside without requiring as much upfront capital as buying shares outright. It also explains why Palisades focused so heavily on this strategy starting in 2024. As for where things stand today, the numbers tell an interesting story. Up until August of last year, the intrinsic value of Palisades' warrant portfolio sat somewhere between $0 and $5 million. That means the warrants were worth very little, if anything, above their fixed exercise prices. Then, as gold prices began climbing sharply, that value surged to around $130 million at its peak. Since then, the broader market has pulled back, and the portfolio's value has settled around $60 million today. That drop from the peak might sound discouraging on the surface, but Colin pointed out something important. Compared to where the portfolio stood just 11 months earlier, near zero, the current $60 million value still represents enormous growth. It is a reminder that short-term price swings can feel uncomfortable even during a market that is technically moving upward over time. Palisades has also been open about slowing down its pace of new investments. During the third and fourth quarters of 2025 and into the first quarter of 2026, the company was highly active, participating in many financing rounds. Since then, that activity has declined. According to Colin, this is not a sign of losing confidence. Instead, it reflects a natural shift. As the bull market matures, financing terms have become less favorable for investors like Palisades, meaning there is simply less opportunity to secure the same kind of value they found earlier. The Palisades Gold strategy raises a broader question that reaches far beyond one company. It points to a gap that currently exists between the price of gold itself and the value of the companies that mine it. This gap carries real consequences for investors, for mining communities, and for the future direction of the sector. Gold prices have climbed significantly over the past 2 years, moving from roughly $2,000 an ounce toward levels near $4,000. Much of this rise has been driven by central bank buying. Governments around the world, including major economies outside the United States, have been purchasing large amounts of gold to strengthen their reserves. Some analysts have linked part of this shift to geopolitical tensions, including decisions made during the Biden administration regarding frozen Russian assets, which some believe pushed other nations to reduce reliance on the US dollar and increase gold holdings instead. However, there is an important detail often overlooked in this story. Central banks buy physical gold. They do not buy mining stocks. This distinction matters greatly for everyday investors. It means that while the price of gold itself has surged, the companies responsible for digging it out of the ground, especially smaller junior miners, have not seen the same level of investment interest. Colin Catel described this directly, noting that despite record gold prices, capital has been slow to flow into these smaller companies. This creates a mixed picture for different groups. For large, established mining companies, rising gold prices generally translate into stronger profits and share performance over time. For junior mining companies, however, the benefit has been delayed. These smaller companies often depend on outside investors, providing capital through financing rounds, the same rounds where warrants are issued. When investor interest lags behind gold prices, junior companies can struggle to raise the funds needed for exploration and development, even during a strong bull market. For communities connected to mining, particularly in regions like Nevada's Battle Mountain Trend, where Palisades holds significant land through its Made in America gold portfolio, this dynamic can also shape local economic activity. Increased exploration and development funding can support jobs, local businesses, and infrastructure. When financing slows or becomes more difficult to secure, that ripple effect can be felt at the community level as well. There's also a broader lesson here about market timing and investor psychology. Colin noted that the recent months have not felt particularly encouraging, despite the underlying data telling a more positive story. This reflects a common pattern in bull markets. Prices can pull back or move sideways for extended periods, creating uncertainty and doubt among investors, even while the longer-term trend remains upward. Understanding this distinction between short-term emotion and long-term data is something financial analysts frequently emphasize as essential for sound decision-making. Different perspectives exist on how this situation may unfold. Some industry voices believe junior mining stocks are simply lagging and will eventually catch up as investor confidence grows, similar to patterns seen in previous gold cycles. Others remain more cautious, pointing out that today's financing environment has changed. Companies now have more options and are less reliant on issuing warrants, meaning the specific opportunity that Palisades captured earlier may not repeat in the same way for future investors. What remains clear is that the relationship between gold's price and mining equity performance is not automatic. It depends on capital flow, investor sentiment, and confidence returning to smaller companies, not just central banks. For everyday investors trying to understand where opportunity may still exist, this distinction between physical gold and mining equities is one worth watching closely. As this story moves toward its conclusion, several questions remain open for viewers to consider. Will junior mining stocks finally catch up to the price of gold the way they have in previous market cycles? Will investor interest widen beyond central banks and begin flowing more heavily into smaller exploration companies? And how long might that shift take, if it happens at all? These are not questions with easy answers, but they are worth thinking about carefully. Colin Catel himself expressed confidence that the broader trend remains intact, even if the timing feels uncertain. He pointed to the fact that many experts anticipate gold could reach $6,000 an ounce by the end of the year. Whether that specific target is reached or not, the larger point he raised is one worth remembering. Bull markets rarely move in a straight line. They often include periods that feel discouraging, even while the underlying data continues moving in a positive direction. Recognizing that difference between short-term emotion and long-term trend is something every investor, new or experienced, may find valuable. Looking ahead, Palisades Gold appears to be entering a new phase. After being highly active in financing rounds throughout 2025 and early 2026, the company has slowed its pace of new investments. Rather than continuing to chase new deals, the focus now shifts toward allowing the existing portfolio, including its 1.7 billion warrants, to develop over time. This does not mean the company has stopped watching the market. If financing conditions become attractive again, Palisades has indicated it remains ready to participate. For now, though, patience appears to be the primary strategy. For viewers trying to make sense of these developments, there are a few practical steps worth considering. Staying informed about the difference between gold prices and mining equity performance can help set realistic expectations. Understanding basic tools like warrants, even without directly investing in them, can also provide a clearer picture of how capital moves through the mining sector. Following credible, fact-based sources, rather than relying on speculation or short-term price swings, remains one of the most reliable ways to stay grounded during periods of market uncertainty. It is also worth noting the ownership structure behind this story. Colin Catel holds 22% of Palisades Gold, making it his largest personal position. Company insiders together hold 45% ownership. Over the past 4 years, Palisades has returned $75 million to shareholders and has not diluted existing shareholders, except in one case involving its second largest shareholder. These details may offer some context for viewers evaluating how closely a company's leadership is aligned with its outside investors. As always, viewers are encouraged to form their own conclusions based on available facts rather than reacting to short-term price movements alone. What do you think? Will junior mining companies finally see the wave of investment that many analysts have been predicting? Or will this gap between gold prices and mining equities continue for some time yet? Feel free to share your thoughts in the comments below. This story, in many ways, reflects a larger pattern seen throughout mining history. Fortunes are rarely built overnight. They are often built through patience, discipline, and a willingness to act when others hesitate. Lessons Colin Catel first learned watching his own father decades ago. That brings this story to a close for now. Golden Crest Finance will continue following developments in the gold and mining sector as they unfold, bringing viewers clear, balanced, and fact-checked coverage along the way. Thank you for spending this time here today. If this story added value to your understanding of the market, consider subscribing so you don't miss what comes next. Until then, take care, stay informed, and we'll see you in the next one.